Asset management is why someone comes to an investment firm, and at Chapwood Investments, we believe our approach is exactly the right approach to build an efficient portfolio for you. What we use is called a top-down, bottom-up methodology. The top-down, imagine yourself in a spaceship looking down at the world and deciding what areas of the globe you want to put money into. Once you've made that decision, then you decide if you want to have equity or debt. Now, 93.6% of the return on a portfolio comes from doing exactly this. And 98%, startling 98% of the risk comes from this, the top down. Now, the bottom up is important, but only as important as 6.3% of the return on an investment portfolio. So that has to do with security selection and market timing. But ironically, we spend most of our time discussing the security selection and market timing, and we shouldn't. We should be following exactly the right methodology and looking at the top down more important than the bottom up. Now, every portfolio at Chapwood is customized because every single person has different wants and needs, so there's no model portfolio that we use. Being independent, we can choose from any investment out there in the world. We're not limited to what our big bulge bracket firm has required us to select for our clients. So there's not an investment out there that we cannot select for our clients and that we can't put you in. We build portfolios at Chapwood following the 8 metrics that I created that are our guiding principle. And this has to do with what rate of return you need to make in order to not lose purchasing power. Standard deviation has to do with volatility, and you want that number to be as low as possible. Any number that is high creates more volatility, and that is not good for a portfolio. Variance drag phantom tax has to do with the standard deviation and the rate of return, and you want your standard deviation to be as low as possible. Therefore, your variance drag phantom tax will be as low as possible. Anything over 1.5 is not good, and you can simply look at a portfolio that we build and see that we're looking to get a standard deviation to be 80% or less, which means the variance drag phantom tax would be 0.8 or lower. Then we look at the Sharpe ratio, which won a Nobel Prize in economics. You want that number to be 1 or higher. Then the probability of any loss in the next 12 months. You want that number to be about 15% or less. So when you're building a portfolio, we are constantly looking at seeing what the probability of any loss is in the next 12 months. Then we look at the amount of money at risk. So based on a portfolio of $1 million, do you have too much money at risk based on historical data? Then we look at the upper and lower return, and we want that number to be as narrow as possible. So you want to have just as good a chance of making this number on a positive side as losing this much money. So you'd rather have a historical rate of return of 10 and a standard deviation of, let's say, 6. Therefore, your range of returns are between plus 22 and minus 2 versus a standard deviation of 15 with a rate of return of 10, and you have just as good a chance of making 40% as you do losing 20%. That doesn't work. That means you have too high a variance drag phantom tax. Then you want to look at the correlation to the S&P 500. You want that number to be as low as possible. This is how you should approach asset management, and this is what we do at Chapwood Investments. We build more efficient portfolios.